Palantir now enables. It allows battlefield
Practically unheard of. The company generated 56.7% free cash flow margin,
directly contradicted by massive systematic
securing Impact Level 5 and Impact Level 6 enterprises to achieve production-grade.
more predictable than the outbreak of kinetic.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
As of early March 2026, Palantir has experienced a 35 to 38% pullback from its 52-week highs, settling into a highly critical technical range between $13 and $45 a share. But what demands our immediate analytical attention right now is the sheer, unprecedented velocity of the trading activity surrounding this retracement.
Right. The volume is staggering. Exactly. Just days ago, on February 26th, we saw a massive $6.2 billion in trading volume recorded in a single session. This brings us to a fundamental intellectual crossroads regarding how we value enterprise technology when it intersects directly with national security. We have to ask, does this current technical range, backed by that staggering multi-billion-dollar liquidity event, represent a generational entry point into the sovereign AI infrastructure era? Or does it mask a dangerous valuation trap, one plagued by off-exchange manipulation and deep insider exhaustion? I will be taking the position that Palantir's fundamental operating leverage, its recent military-grade technical accreditations, and the massive sovereign wealth accumulation we are witnessing right now absolutely justifies its premium market position.
And I will be taking the position that the company's extraordinarily rich 123 times forward earnings multiple is highly precarious. It's heavily obscured by an opaque, dark pool market microstructure and, frankly, directly contradicted by massive, systematic insider liquidations.
Let's stop by looking closely at the empirical financial reality of Palantir right now, because the fundamentals are operating in a completely different stratosphere than traditional software-as-a-service companies. In the fourth quarter of 2025, revenue hit $1.41 billion. That is a 70% year-over-year increase. But the growth is really only half the story. When you combine that top-line growth with their profit margin profile, you arrive at an incredibly rare Rule of 40 score of 118%. For our listeners who might not look at SaaS metrics every single day, the Rule of 40 is a benchmark combining growth rate and profit margin. Usually, if a software company hits 40%, they are considered elite. Finding any enterprise software company operating at scale with a score of 118% is a statistical anomaly.
It is a massive number, sure.
Right. And furthermore, the cash conversion efficiency is practically unheard of. The company generated $2.3 billion in adjusted free cash flow for 2025, and management is highly confident in their projection of $4.025 billion in free cash flow for 2026. We are talking about a 56.7% free cash flow margin. That essentially means for every dollar Palantir takes in, they are keeping roughly 56 cents in pure cash. You do not generate that kind of cash unless your product is so deeply glued into your client's operational architecture that it becomes practically irreplaceable. And the smart money clearly recognizes this. Norges Bank, which manages the Norwegian government pension fund, just made a massive $5.15 billion entry into the stock, acquiring 28.9 million shares. That is the ultimate validation. Sovereign wealth funds don't allocate $5 billion on a whim. It proves Palantir is no longer just a vendor, it is viewed as mission-critical Western infrastructure.
I come at it from a different way. I acknowledge the impressive growth and those cash flow metrics, obviously, but we have to ground our analysis in the reality of equity pricing. The valuation is fundamentally disconnected from market reality. Trading at 123 times forward earnings and roughly 90 times next year's earnings requires a level of flawless execution that leaves absolutely zero margin for macroeconomic or sector-specific error. To put that multiple into perspective, paying 123 times forward earnings means you are theoretically paying for over a century of current profits up front. It demands perfection. But the most glaring contradiction to this entire generational sovereign AI narrative is the behavior of the insiders who know the company best. If this is truly a generational shift, If Palantir is the indispensable backbone of the global AI build-out, why are the architects of the company aggressively rushing for the exits?
Well, they are paying taxes primarily.
It's far more than just taxes. We just saw Peter Thiel liquidate $290 million in early March 2026. This is happening alongside massive 10b5-1 automated sales from the executive suite. Over the last 6 months, the CEO sold 897,914 shares for an estimated $131.9 million. Director Cohen liquidated $104.4 million, and CTO Sankar extracted roughly $50 million. Sure, executives need to pay taxes, but you cannot ask public market investors to underwrite a 123 times multiple based on a conviction narrative when the company's leadership is systemically extracting hundreds of millions of dollars of liquidity right at the top.
I think it's important to contextualize those insider sales. As you mentioned, they are largely executed under prearranged 10b5-1 plans. These are automated programs set up months in advance precisely to avoid the appearance of timing the market. But even setting the optics aside, those sales do not negate the fundamental reality of what Palantir is actually building, specifically in the defense sector. Palantir has cemented its status as the preeminent dual-use equity in the market today. Let's look at the catalyst from February 12th. The company received authorization for its Palantir Federal Cloud Service Forward from the Defense Information Systems Agency. By securing Impact Level 5 and Impact Level 6 accreditation for on-premises and edge deployments, Palantir solved the single hardest problem in modern warfare.
The deployment problem. Exactly. They solve the AI deployment problem in disconnected, denied, or intermittent latency environments, what the military calls DDIL. Imagine trying to run complex AI analytics in the middle of a desert, completely cut off from the cloud, while under hostile electronic warfare jamming. That is what Palantir now enables. It allows battlefield commanders to run high-end analytics on hardware-agnostic infrastructure right at the tactical edge. We saw the immediate market realization of this on March 2nd. Following the US and Israel military action against Iran, Palantir's stock jumped over 5% intraday. The market inherently understands that in real-time defense utility, Palantir's software systems are completely unrivaled. Geopolitical escalation forces accelerated procurement cycles, which directly benefits their bottom line.
But that is exactly the fragility I am pointing to. You are building a core investment thesis on the unpredictability of global instability. Questioning the long-term durability of geopolitical spikes is absolutely essential here. Yes, the stock jumps 5% on headlines of military action in the Middle East, but what happens when the defense budget cycle normalizes? While Citi has a $260 price target assuming Palantir is this indispensable battlefield operating system, you have RBC Capital setting a price target of $70.70. And that RBC target focuses precisely on the very real risk of government contract deceleration. Relying on continuous global conflict to support a 123 times forward earnings multiple introduces unquantifiable risks into the valuation model. The moment a major government contract is delayed or a procurement cycle stalls because the geopolitical temperature cools down, that multiple compresses violently. The foundational demand has to be more predictable than the outbreak of kinetic warfare.
I would argue the demand is highly predictable precisely because the nature of modern multi-domain operations has fundamentally changed. The military cannot suddenly revert to analog systems or disjointed databases. The data integration Palantir provides is a permanent architectural shift. But look, if we're going to justify that kind of valuation, we really need to look under the hood at how Wall Street is actually physically trading the stock. The underlying mechanics of price discovery are critical here.
I'm glad you brought that up because the market microstructure right now is flashing major warning signs. You opened by citing that massive $6.02 billion in trading volume on February 26th. We need to completely deconstruct that figure. When retail investors see $6 billion in volume, they assume a massive stampede of natural buyers. But the lion's share of this liquidity is dangerously opaque. It is being processed through dark pools controlled by high-frequency trading firms and wholesalers like Citadel, Susquehanna, and Virtue. This isn't transparent, open market price discovery. Furthermore, look at the technical structure. Despite all this volume, the stock is continuously struggling to break its 200-day simple moving average, which currently sits at $161.
When you have unprecedented off-exchange volume and the stock cannot sustainably clear its long-term trend waterline, it strongly suggests that the massive volume isn't institutional accumulation. It is using the dark pools to quietly offload their positions into the retail hype without crashing the bid.
I see why you think that, but let me give you a different perspective on how we interpret that dark pool data. Those massive off-exchange transactions, what quantitative analysts call signature prints, actually indicate massive institutional support. During this pullback, dark pool scanners identified significant delayed prints specifically at the $128 and $136 levels. These are highly informed actors positioning themselves ahead of catalysts. They are establishing a formidable technical floor. And we can cross-reference this with the derivatives market to prove it. In mid-February, we saw highly unusual options activity where sophisticated floor traders sold over 5,500 out-of-the-money puts at the 128 strike. For our listeners who don't trade options, selling a put basically means you are legally promising to buy the stock if it drops to $128. They were harvesting a yield of 0.89% for taking on that obligation.
Right, they were just collecting premium.
Yes, but you do not write thousands of naked put, risking massive capital, unless you have supreme institutional confidence that the $128 dark pool floor is actually going to hold. If they thought the stock was going to crash, selling those puts would be financial suicide. This is sophisticated yield harvesting at a proven support zone, which runs completely counter to the idea that institutions are quietly abandoning ship.
Selling puts for yield in a high implied volatility environment is classic momentum behavior, but it does not equate to long-term fundamental support. Wholesalers are managing the order flow to keep that volatility profitable for themselves. It's financial engineering, not a reflection of intrinsic value. We need to look past the options chain and return to the actual business model, specifically on the commercial side, because that is where the growth narrative is supposed to be the strongest. You claim the valuation is justified by their ability to scale outside the government sector.
Absolutely, and that is where the numbers are undeniable. We have to pivot to the U.S. commercial segment, which is the true engine of their scalable growth right now. The U.S. commercial business grew by an astounding 137% year over year. This completely dismantled the old bearish argument that Palantir was just a glorified, lumpy IT consultancy. Their new bootcamp sales motion allows enterprises to achieve production-grade AI deployments in a matter of days, rather than months of arduous integration. They have effectively broken out into a highly scalable SaaS platform. And strategically, their decision to move the corporate headquarters to Miami in February to embed in the defense finance corridor is brilliant. They are placing themselves in direct proximity to their most critical commercial and institutional client bases.
I will certainly acknowledge the commercial growth. Hitting 137% in the U.S. commercial segment is an undeniable achievement. Building out that SaaS platform model was crucial for them. However, you are glossing over a structural headwind that terrifies fundamental analysts when they look at this company, which is severe revenue concentration. Palantir's top 20 customers are now averaging $94 million each in revenue.
It's enterprise software. That's expected.
Expected, yes, but extremely dangerous at this multiple. That level of concentration means the loss of even a single major client could completely shatter that fragile 123 times forward multiple. Enterprise software is notoriously fickle. When a single chief information officer decides they want to migrate to a cheaper, open-source alternative, Palantir loses nearly $100 million in recurring revenue instantly. That is why I suggest the current 35 to 38% pullback isn't just a healthy reset. It is a technical breakdown that is currently being masked by algorithmic momentum. If you look at the Adaptive Select ETF, ticker ADPV, it holds a 12.4% weight in Palantir. This stock is being propped up by passive momentum flows from index funds and highly concentrated commercial contracts. That is a structural ceiling, not a scalable floor.
But betting against Palantir at this juncture means betting into a company that is compounding a 118% Rule of 40 score. It requires betting against unmatched U.S. commercial growth of 137%. And essentially ignoring the unprecedented sovereign wealth accumulation we are seeing. Entities like Norges Bank do not allocate $5 billion based on the short-term flows of momentum ETFs. They look decades into the future. They are securing generational infrastructure, And they recognize that Palantir software is becoming the indispensable operating system for both Western defense and advanced enterprise AI.
And no amount of fundamental growth makes a 123 times forward PE safe. That is just mathematical reality. You are pricing in a flawless future in a highly dynamic, competitive market. It becomes especially precarious when the company's own leadership, the founders and executives who built that architecture, are extracting hundreds of millions of dollars in liquidity through off-exchange mechanisms right at the absolute peak of the sovereign AI narrative.
We do find ourselves in agreement on a broader, undeniable shift in the landscape, though. Palantir has successfully transitioned from a secretive, engineering-heavy consultancy into a highly scalable global platform play. Furthermore, the core premise of their offering, that artificial intelligence is shifting rapidly from a commercial luxury to an absolute national security necessity, has been proven by both the geopolitical events and the enterprise data we've seen throughout early 2026.
That transition to a scalable platform is clear, and the necessity of deep data integration across both military and commercial domains is absolutely undeniable. The complexity here truly lies in how public markets are supposed to value dual-use infrastructure over a long time horizon, especially when defense utility and commercial scaling collide in a market where multiples are heavily scrutinized.
The true trajectory for the rest of 2026 ultimately hinges on execution. Specifically, it depends on whether Palantir's management can materialize their guidance of 115% year-over-year commercial revenue growth. If they achieve that, it forces a complete recalculation of the multiple by the broader market. We leave it to the listener to explore the underlying dark pool order flow and the enterprise commercial metrics themselves to decide if the current 130 to 145 technical level is indeed a generational floor or a structural ceiling.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!